All right. Well, good afternoon, folks. Welcome to the Q2 market commentary. I appreciate everybody joining us today on a somewhat rainy day. I walked out in it today. It was terrible, and it kind of reminded me that Vancouver weather and the markets have a lot of things in common nowadays. They're both terrible with the occasional nice days. So today what we're going to do is we're going to unpack not only what's happened in the past quarter, but also talk a little bit about what's been transpiring in the markets, how to navigate it, what we're seeing with clients, some of the feedback, and then as well, how we prepared for these types of markets and uncertainty that we tend to get every few years. So with that, I'm going to jump into it. First thing I'm going to actually do is if everybody can do me a favor, we usually do these on a quarterly basis, these calls or sessions. What I would like to do with your permission, if you think there would be enough people that would join me, is start to hold these on a monthly basis. The reason why for a monthly basis, obviously things are very fluid in the markets. The next one would actually be in early May. And I'd also see if we can maybe get some guest speakers. So our chief investment officer might be one that we might bring on. She can chat a little bit about what's going on in the markets, more from an economic point of view. So if you would like to see us hold these more frequently, just go into the question and answer box, which can be actually found, or the tab, which can be found at the bottom of your screen, and just type in Y for yes or N for no. Just let me know. I'd like to just get the general vibe of the folks. All right, I'm already getting lots of all yeses so far. So okay, like I said, let them keep them coming. Perfect. It's an overwhelming majority. Within 30 seconds, we will hold the next one the first week of May. I will actually have an invite go out probably in about 2 weeks, 2 to 3 weeks. And I'll also let you know if we can actually get our chief investment officer to join us. I'll do my best to try and get her. I know she's very busy at this time of year, but I think she'd be fantastic. She's super dynamic and well-spoken. And like I said, we'd be fortunate enough to get her. So, all right, so we're going to start here. So agenda, as I mentioned, Q1 comments. What did the new administration inherit? Obviously, as there was a change in administration. Then we're going to spend a little bit of time unpacking this whole market situation. And then lastly, as I mentioned, we're going to talk about how did we prepare. And folks, I'm not going to get super technical. I hope this information that I put together is helpful for a lot of folks on this call. This is probably our most attended call in recent memory. No surprise given what's going on in the market. Again, I'm not going to get overly technical. If you do want some additional info or have questions, feel free to reach out to me personally, or you can also add your question in the Q&A box that you just typed in the yes. I see a couple of questions that have already come in. So I will do my best to answer them as we go through or at the end. So just type it in as we go through. All right. So what did the new administration inherit? I think this is really important because in the last 3 months, or as a matter of fact, in the last 6 weeks, things have deteriorated. So coming into the year, the S&P 500 had done something that it hadn't done in almost 30 years, which is to post back-to-back gains of 20%. So the administration, or the Trump's administration, inherited a fairly strong market that was coming off the last bear market 2 years ago. And if we look at earnings seasons or look at earnings forecast, we can actually see, as we went through this bear market or this contraction in 2022, where corporate earnings had contracted, we were actually coming out of that and throughout the back half of 2023, 2024, and even forecasted into 2025 and 2026, there is anticipated revenue growth and earnings per share growth. So why I bring that up is not only were they inheriting a good market, they are also inheriting a fairly positive economic outlook for corporations. The last reporting season, which happened obviously throughout Q1, roughly speaking, 70 to 80% of the companies that reported either met or exceeded their earnings expectation. So coming into the presidency, there is a lot of optimism for the markets. And as a matter of fact, within the first 3 to 4 weeks of him taking office, markets had an incredible run. Now, not only was it a fairly good economic point of view, but again, from some of the key deliverables, when we look at it, and this chart here just shows various presidencies: Clinton, Bush, Obama, Trump 1, Biden, and Biden, or Trump 2. And we can see unemployment rate was actually falling. Monthly job growth was positive. And even stock price, which I just mentioned, was actually very robust. And then when we look at actually some quarterly variables, GDP growth was the strongest it had been in almost 4 presidencies. So overall, Biden, whether you liked him or not, and Trump, whether you like him or not, handed over a pretty good market, pretty good economy. Well, what's transpired since? And one of the things we talked about in our previous session was some of the risk coming into this year before we got to this whole tariff situation. And so what we said, hey, listen, like there's a lot of good things going on, but here are some of the things that we're concerned about and on our radar. So number one was valuation risk. So given the fact that this artificial intelligence wave has happened, it's supercharged the performance of some of the biggest stocks on the market. And you might think of the biggest stocks as the Mega 7, so the Apple, Meta, Amazon, Google, and so on. So some of these companies drove the market to heights that we hadn't seen in quite some time, okay? And when this chart was done, the US market was at its highest valuation relative to the rest of the world in almost 4 decades. Now, beyond just valuation, there was also concentration risk, and I talked a lot about this. Concentration risk, because we've actually had a lot of growth within the top part of the market, roughly 37% of the S&P 500 was in the top 10 stocks. Now, this isn't overly unusual. The S&P 500 tends to be top heavy, but generally speaking, the top 10 would typically represent between 20 to 25%. The bigger issue is the top 37% of the S&P 500. Over a third of that, or roughly 33%, was just the top 7 companies. So what we actually had is we had a lot of duplication amongst the NASDAQ, amongst the S&P 500, and so on, of a lot of similar companies. These 7 companies represented over 50% of NASDAQ. So what we're seeing today is, as we're seeing a pullback in NASDAQ, we're also seeing it in the S&P 500 because we get this concentration and duplication across these multiple markets. Now, these were concerns that we recognize coming into the year, okay? So fast forward to just, about a month ago when this tariff conversation started to come up. Now, initially speaking, like I said, we had planned for some of these hiccups, some of this volatility. And one of the things you've often heard us say, it's not how we will react in the midst of a correction or in the midst of volatility, but rather how we prepare. Because we recognize it's going to happen. It happens every year generally. Corrections are normal. Okay, and when I say corrections, it's usually, drops upwards of 10%. And then from time to time, we get bear markets, which happen much more infrequently. So the key takeaways from the policy announcement of the tariffs. So number one, broad-based tariff expansion. So obviously they came across with a sweeping 10% baseline tariff. And it was some sectors or some goods and services, they had it as high as 25%. Here in Canada, obviously auto parts that were effective immediately. And again, they targeted global markets as well. And you're probably seeing today, they've increased the tariffs on China, which has affected the markets again. Markets actually weren't terrible today, but they did whipsaw quite a bit just based on the uncertainty. From a political point of view on the Canadian side, obviously there's growing discussion of a Team Canada strategy, and especially amongst provincial leaders. But political cohesion remains fragile. So again, they're working towards mitigating some of these tariff concerns, but again, they're not quite there yet. From a market and business sentiment, we're seeing in retailers specifically and U.S. importers, they're already feeling the pressure. And there was a video that came out when Trump announced tariffs last week, and for a lot of you, you probably recognize the furniture store, the retail store, Restoration Hardware, but the CEO was actually on an earnings call. Was on an earnings call as the tariffs were being announced, and his reaction to the tariffs negatively impacted his stock. His stock dropped 40% that day. which was incredible. Okay. And then from a Canadian election point of view, obviously, us voters were increasingly focused on which party leader is likely best positioned to manage relationships with the Trump administration. So again, there's a lot of things that we're concerned about with obviously the political landscape here at home. But one of the big issues, or one of the big concerns that we have, is how are they going to address what's going on in the U.S. and how will that affect our economy? Now, given the tariffs, given the uncertainty, markets have reacted sharply, and officially they've entered into some of these have actually entered into a bear market. Now, a bear market is defined as a drop from the high point to the low at 20% or greater. Okay, and they have actually hit it. And so again, we see these bear markets from time to time, but what's happening right now is it's not a fundamental issue with the markets at this stage. A lot of what's happening right now is actually event driven. There's conversations, there's policies that have been enacted, and very quickly the market prices in the potential slowdown or the impact to companies based on these tariffs. And what's important for us is when we look at tariffs, it's not the countries that pay them, it's the companies that pay tariffs. And at the end of the day, the countries that are importing pay the tariffs, but they're just not going to accept a reduction in their revenue or their profit. They're going to actually recoup that at the bottom line, which is through us consumers. That's the problem. And so things are going to get more expensive. We're obviously talking a lot about inflation where we were trending down, but all of this is going to work its way down into the consumers, and inflation could actually rear its head, which is problematic because central banks may not cut interest rates as quickly as anticipated. And the US Fed has already come out and said that. They said, hey, we are not planning to cut rates based on what's going on from this tariff policy. We will cut at the proper pace. They're more concerned about what's going to happen with potential inflation. Job markets numbers actually came out in the US recently. They were very strong, which again is problematic from an inflationary point of view. And if we look at where Trump is, from running the economy, the country, it's actually the worst start for a president since 2001. So in almost 2 decades, the S&P 500 is off to its worst start after 52 trading days, which is terrible. The one maybe good thing or silver lining, perhaps, again, whether you like him or not, but Trump is very much, he wants things to be prosperous. He wants things to go up. If things continue to deteriorate, I think he's driven to the point where he's going to want to do things to actually improve the markets in general. Because again, this isn't a very popular a policy that has actually come out. It's actually hurting a lot of Americans. And the last piece I'm going to talk about with where we are from Q1 into just here early Q2 is there's a lot of chatter about a potential recession. Okay. And if we actually look at this chart, how to read this chart at the beginning of the year, actually, if you look at this red line here, this is the chance of a recession without any policies, without any fundamental deterioration, anything. It's just the likelihood of a recession. Okay. Baseline 13%. Well, as we came into the year, very low probability of recession. But when we fast forward over the last few weeks, it's actually increased significantly. And I actually saw an article yesterday that they actually think it could be as high as 60%. And so what defines a recession? We haven't had one in a while, but what defines a recession is back-to-back negative GDP quarters, okay? So negative gross domestic product quarters. Now with recessions, what happens is it's always backwards looking. And this is important to know. So we could be in a recession today, but what happens is after we get through 2 quarters that signify back-to-back negative GDP growth, then the economists come out and they say, hey, looking backwards, we were in a recession 5 months ago, 6 months ago, whatever it is. Well, it's the same is true when we come out of a recession. So what happens is things start to pick up, markets start to price in, upside. And what happens is after the markets are rallying, economists come out, they look backwards and say, hey, we were actually out of a recession 3 months ago or 7 months ago. And the reason why is, the market, it's a key indicator. It tends to start pricing in things that that could be impacted earlier than when recessions are now. So let me just give you a really quick example. Let's say a retail store came out and they came out and they said, hey, you know, given the tariffs or given what have you, we're going to shut down 50% of our stores because the profits aren't as strong as what we would have hoped. Well, that share price, if it's a publicly traded company, is going to be impacted immediately. So it's not going to wait for those half of those stores to be shut down in a year. It's going to actually decline right away because it's anticipating the slowdown. Okay. So if 6 months go by and all of a sudden that company comes out and says, actually, we're in a much better position. We're actually going to increase our store growth by 30%. Now, all of a sudden, profits they are going to be stronger than anticipated. Now, all of a sudden, that share price might go up today versus waiting for 6 months for those stores to be built. So going back to what I was saying, markets tend to price in negative news early, and they tend to price in positive news early before things actually come out. All right. All right, so I'm going to actually just change gears here. And I want to really use this opportunity to educate investor behavior. And this is actually really important, just given the fact that, you know, there's a lot of things that are happening right now that create some anxiety, a little nerve-wracking. Like I said, we want to make sure that we kind of hold people's hands as we go through this period of uncertainty. So the first one here is, again, hopefully a few of you are having a chuckle here. So what we know, you know, and we see this on the news right now, is negativity or bad news sells. And the reason I bring this up is I was like, even today, I was looking at the TV, and for 8 hours straight across the bottom ticker, it was giving you like 30-second updates on what was happening on the market. You know, plus 5%, plus 4%, plus 3%. And then Dow Jones down 1%. It was constantly in your face all day. Okay. And so if you look back, you know, they've done some studies, and this is one where they looked at magazine sales. Okay. And what they actually found that magazine sales were stronger if there was negative news on the cover than if there was positive news. And it makes sense. You know, even if you go way back when we had newspapers, you know, if there was bad news in the market, usually on page 1 of the business or sometimes page 1 of the main section of the newspaper. But when things happen on the positive side, it would usually be buried 5, 6, 7 pages deep. Okay. No different than this. So as an example, you know, one of the things that I talk to folks, and some of you might have seen this before, but, you know, we hear about, you know, shark attacks that happen at the beaches in Australia or Hawaii or what have you. And I can think about how often I see those. Okay. But rarely do we ever hear about, you know, lion attacks or hippopotamus attacks. It's not as sexy. It doesn't sell as much. So if I were to ask you guys, you know, of these three creatures, which one do you think, you know, humans pass away from more often? Would it be the shark, the lion, or the hippopotamus? Okay. Now, again, some of you might be typing in right now. You'd be surprised to know the great white shark, you know, unfortunately takes 6 people a year. That's it. Okay. Lions are actually more dangerous, 22, and hippopotamuses, 500 people a year die from hippopotamuses. Yet, when was the last time you saw on the news somebody perishing from a hippopotamus attack? I can't remember the last time I saw something like this. And the last time I heard about a hippo on the news was during Christmas at the song, "The only thing I want for Christmas is a hippopotamus." So this is a good example of how negative news, the more alarming it is, the more front page news it gets. Okay. So let's actually unpack what happens in the market. So listen, guys, there's always reasons to sell. There's always reasons to cause anxiety. This goes back over the last 16 years. And these are all the various situations or events that at the time were pressing. Okay, we have COVID-19, we had presidential elections, we had, sovereign debt crisis, we had bankruptcies, Chrysler and GM. But at the end of the day, despite the ups and downs, markets have grown. And if you go back over the last 100 years, the market charts look just like this. Okay. And in the middle of it, it feels like nothing will change. So even if we went back here, you know, here's COVID, right? COVID was very short-lived. All right. It was one of the biggest drawdowns that we've had. Some of the worst days in history happened in 2020, okay, on the markets in terms of percentage declines. Now, the flip side, some of the best days also happened during March of 2020. But when you look at the full length of a market, COVID is just one of many events that have happened throughout the years. Now, I talked about this earlier. I talked about corrections are a normal part of investing. And unfortunately, we tend to anchor our emotions or behavior to things that have happened in the most, more recently. And up to just this year, we haven't really had a lot of negativity in the markets. Coming out of the kind of the inflation and high interest periods, we had nothing but upward growth. Okay. We went through a period of almost 300 days, over 300 days, where the market didn't have more than a 2% decline. It was just constantly up, 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 or if it was down very little. Okay. So what this chart actually reminds us of is every year there is a correction or a negative drawdown throughout the year, even if the markets are positive. So here's an example. Here's 2013. 2013, the S&P 500 was up 14 or 41%, but it was down 5% at one point. Okay. Here's another one in 2020. This was COVID. As at one point, the S&P 500 was down 27%, but it finished positive at 16%. So when you look at the average declines over the last 45 years, the average drawdown throughout the year has been 12.8% on average, some more, some less. And over those 45 years, 36 of them have been positive. Okay, so again, it's a reminder, we were very early into the year. I know there's a lot of nervousness or anxiety, but again, this could be short-lived if all of a sudden we actually see some positive news come out about trade around the world. And the last one was the S&P. I get accused that I don't share enough about the TSX, so I thought I'd put this chart in. These are the top 10 years on the TSX over the last 60 odd years, 70 odd years. Even in the best years, the top 10 years, the max drawdown in those years, again, averaged 10%, with some of them as high as a lot of double-digit declines in here. So again, just as a reminder. Okay, this brings it in this next slide. So average bear and bull market. The reason I put this in is we're starting to hear the term as bear market. And for a lot of folks, they're like, well, what is a bear market? So I thought I would talk about it. So a bear market, which I mentioned earlier, bear market is when the markets contract or they fall 20% from the peak to whenever they hit the 20% down. When it hits 20% down, they say, hey, we're in a bear market. Okay. And it could actually trade amongst, they're down there for a little bit. And then when things level off and they start to go up, if we get a gain of 20%, so positive 20, then we go into what's called a bull market, which is an upward swing of the market. All right. So again, when we go back, and I'm not even looking, all history, but in the last, 40 years or so, we've had a lot of bull markets. Bull markets tend to be longer than bear markets. Okay. On average, bull markets lasted 36 months. So 3 years, which is on the lower side. Generally speaking, they're about 5 to 7 years. And then bear markets tend to be roughly, 10 months to a year. All right. And so when I say to folks, a mid to long-term time horizon, some people will say, hey, given my age, I don't know if I have a long-term time horizon. Well, I always think about time horizons or long-term as market cycles. So if a market cycle is, 5 to 7 to 8 years, to me, that's a little bit of a longer term. Short term is, 1 to 2 to 3 years in general. So when we look at this, again, these bull markets are signified by longer periods of time, sustained growth. And then again, generally the shorter ones here, these gray ones are the bear markets. Okay. And this is COVID right here, guys. This is COVID, which lasted only 2 months. It was very short-lived because it was event-driven. It wasn't fundamental. We had a global virus that shut everything down. And once we got through that, things recovered. The economy continued to grow. All right. Again, talking about managing emotions. How do people invest? Okay. I came across this graph. I've showed it before in different versions, but I think it's actually really important about human psyche and how we invest money, how we redeem money. Okay. So it's interesting. This is the market. This is the MCSI, but this is the market over the last 2 decades. Okay. And when you see there's periods that are negative, you can see these big draw. This is 2008. Okay. And we see periods where it's positive. And what's interesting, what we see is when things get negative, that's when there's an outflow of cash from the market. So investors are selling, right? In emotion, they're saying, hey, I got to get out. But when markets go up, they're not investing money as things rise. They actually invest money once things get better, because there's this fear of missing out in the markets. So what we generally see is in good markets, that's when everybody is adding money. Okay, bad market, everybody is selling again. Now that's not what's happening here. You know, the feedback that I've received over the last week from the families that we work with has been very positive. And as a matter of fact, I'm getting people that are saying, hey, I have some cash on the sideline. I've been sitting on it. Is now a good time to invest? Well, I don't know if today is the best, but what a lot of them are doing is they're saying, well, maybe today isn't the right one, but I know in the next little bit it will be. So we're getting ready. People are sending in cash. We're parking it in the short term. We're getting ready to deploy it when we get some positive news in general. Okay. You don't want to wait until the market recovers before we start adding money to the market, or if you have that opportunity. If you have a mid to long-term time horizon, it's a great time. You know, you look at Warren Buffett. Warren Buffett is just licking his chops, waiting for good value to continue to happen out there. He has cash he's going to deploy into the markets. These are the best opportunities for him. These are the best opportunities for our families as well. Okay. And for a lot of you, I sent out an email last week. This is a really good example, okay, about being disciplined. So we just went through, the markets just went through back-to-back 4% declines. Okay, it just happened. For a lot of people, they said, wow, we haven't seen that very often. It was the fifth or sixth worst 2-day stretch in the markets. Well, naturally, it's human nature to say, hey, I need to get out and I need to sit on the sidelines. But the problem with that, nobody has a crystal ball, but generally speaking, when we look at the last 4 or 5 back-to-back 4% days, which has happened here, you know, within the 1 to 2 to 3 months, still a little uncertain. But when you get out 6, 9, 12 months, look at the returns of the markets. They're phenomenal. Okay. The problem is that people go to cash in here, which again, we can coach or counsel our folks whether they should or should not. What happens is once you get out, it's really hard to get back in. You don't know really where to get back in. And what generally happens is they miss the opportunity. They get out on a low, markets recover. And once they feel comfortable enough, once investors feel comfortable enough, that's when they reinvest. And that gap between when they get out and when it goes back in generally is lost opportunity. They crystallize their decline, which they'll never get back. Okay. So it's a better way to manage the risk is, you know, invest your money based on your risk tolerance and your time horizon and ride out some of the waves that we're seeing. Okay. This is what we did in 08. This is what we did in 17, 18. This is what we did in 2020, 2022. In all cases, markets recovered and much, much more. And then this is another chart that I sent out. This is just one that says, hey, what if I'm on the sidelines? I miss, the 10 best days of the markets, okay, on an annualized basis. If you stay invested, this is what the S&P has done over the last, 45 years. If you miss just the 10 best days, your average annualized return drops by 30%. It actually goes from 10.3 to 7.4. You miss the 20 best days in that period, your annualized rate of return goes to 5.5%. Okay, so again, I'm not saying that it's not a bad thing sometimes to sit on the sideline depending on your situation. The problem is when we get to timing the market, it's really difficult to know when to go in and go out. And again, Warren Buffett doesn't do this. He invests with a mid to long-term time horizon, and he shifts his thinking, tweaks the mix to take advantage of it. So he never goes all in or all out. Okay. And then my last piece here before I move on to how are we prepared, this is a good chart that just happened in the last 24 hours. Okay. And so I say, hey, how might this play out? I don't know how many of you read the news or watched the markets yesterday, but yesterday there was a really interesting period that happened about an hour after the market opened. And what transpired was there was some information that came out that was reported that there was perhaps going to be a 90-day tariff delay came out on X, or the old Twitter, okay, and then it was corroborated by media sources. And within the next few minutes, the market rallied almost 8%, 7 to 8% in a matter of minutes, okay? Because again, this is an event-driven issue within the markets right now. You know, Trump could come out, change his policy today, markets will rally there like right away. There's no question, okay? So what happened yesterday is we saw the significant increase. And then when they realized that it wasn't, the news wasn't factual, then things came back down, and then we saw the markets trade sideways for the balance of the day. But what this leads me to believe is that, again, once we get some positive outlook on what's going on, we will likely see a very rapid increase in the markets. And one of the things I chatted about recently is, you know, for all the bad days that we've seen in the last week, a lot of times the best days are clustered together with the bad days. So I wouldn't be surprised if we get some positive news and see some of those good days in the very near future. All right, so shifting gears, how have we prepared? What have we done in anticipation for the volatility? Okay. So number one, I think this is key. Diversification is key. Folks, we don't just own the Mega 7 or the tech stocks. We don't just own Canada. We don't just own US. Actually, that's a good segue. I'm actually in a lot of folks that are saying, hey, should I just get rid of all my US investments? We can. If you don't believe in them, or you just don't want to have anything to do with US investments, we can certainly do it. The problem with getting rid of all the US investments is, what do we invest in from there? Would it be Canada? The challenge with Canada, it's a very narrow market. We have three major sectors. We have we have banking or finance, we have resources, and we have commodities. They make up roughly 3/4 of our market. In addition, Canada represents a very, very, very small amount of global markets, okay? So that what's problematic is home bias investing, or investing just in Canada, really limits on the types of investments or sectors you can own. Now, if you're looking for cash flow, dividend producing, there's great companies, but again, very narrow. So when you look at the US, you know, if you look at the top 10 companies in the world, the US actually holds like 7 to 8 of them. So there's a lot of large companies, and a lot of those companies that are in the US, they're contributing to this next innovative wave, which is the AI, robotics, and so on and so forth. So you don't want to be missing those opportunities as well. So, you know, back to my comment, can we get rid of US stocks? Yes, we can. Do I think that would be problematic? Potentially. So that's why it goes back to say, hey, let's be diversified. Let's own Canada. Let's own US. Let's own some global. And then let's complement that with things that reduce your risk, okay? And we've done that through various investment vehicles, some that hedge currency, some that are more alternative, so outside of more traditional thinking. And so when we look at this chart here, you know, there's cash, fixed income, Canadian, US, international, emerging markets. We can see some of the areas, international and emerging markets, you know, you take on the most risk with them. You can have some of the biggest drawdowns, but you can also have some of the best returns. But the average is somewhere in between. So what we do is we tend to take a more diversified approach that has less downside and doesn't have as much on the upside. But again, the benefit is that we actually minimize the volatility for our families. Now, how is the CPP adapted? For a lot of you, you've seen this chart before. So when you look at the Canadian pension plan, they don't own just traditional assets, which are stocks and bonds. So when we look over the last 20 years, you know, back in 2005, when you looked at alternative investments, private equity, real estate, infrastructure, private credit, and so on, the CPP only held just over 4% of the investable assets in these asset classes, okay? They recognized that they needed to get more consistent and predictable returns that actually provide a good, strong cash flow for Canadians. And they also recognized that, you know, Canadians, there were more people drawing on the CPP plan than were contributing. So it's really important for them to smooth out the returns and get consistent, predictable returns. So when you fast forward to 2018, over 13 years, 50% of how they manage money was in these alternative asset classes, okay? Now, you might say to me, Wes, this is really outdated. It's 7 years old. It's absolutely correct. So if we fast forward to 2023, okay, they've received an annual rate of return of just over 7%, but they haven't done it in just traditional asset classes. They actually have done it with these alternative asset classes. And today, or in 2023, their fixed income and public equities only represented roughly a third of their overall mix. Okay. So why do pension plans, and this is the CPP, if you looked at the Ontario Teachers Pension Plan and you looked at our healthcare plans, they would all be invested very similar. So why is it that institutions or pension managers, endowment funds invest money this way, but a lot of Canadians cannot access this? Okay. Well, I'll tell you, most of you on this session, whether you realize it or not, you do actually access alternative investments. So we actually own private credit, we own private real estate, all of it, which is income generating, and we have infrastructure in there. We have storage, multifamily is a big one, student housing. Again, on the private credit side, again, we get mortgages, we get specialty finance, mid-market lending, and so on. And so what we've done is not only have we used the more traditional asset classes like stocks and bonds or fixed income, but we've coupled that with alternative asset classes like private credit and private real estate. So just quickly, so why private real estate? So just a couple of things: strong income, there's good, strong return potential. Plus, we also get capital appreciation, so capital growth. It's low correlation, so it's negatively correlated to generally publicly traded securities. And in general, has lower volatility. The other thing that's a benefit that is not on here is the distributions or gains that our clients get in private real estate through Foresight. You get tax-preferred distributions. So it does pay out, I think it's roughly 4 or 5% a year, but you also get capital appreciation. Most of it's treated as capital gains. So it's taxed at half the rate, which is great. So when we look at public real estate that you can buy on the TSX, and I'm just going to give you this quick example. So in Langley, for those of you that know the area, so in Langley on the bypass, it's right down in the main core of Langley. There are 2 properties. There's a golf town, Cactus Club on one side. On the opposite side, there's a Starbucks. I think there's a Winners and an Indigo. Well, those 2 properties are owned by RioCan. RioCan is a Canadian REIT that trades on the TSX. You can buy and sell it, okay? Now, what's problematic with these publicly traded REITs is there's a lot of volatility. And so what I've done here is I've just looked at a Canadian, the TSX Composite Real Estate Index, and then I've also looked at a US one, and then also another a Canadian capped REIT index, just to give a couple of proxies. Well, if you look over the last 3 years, okay, these 3 indexes that track publicly traded REITs are down anywhere between 10 to 15%. And this is not in the last year. This is total. Okay, this is if you would have invested $100 3 years ago, you would only own anywhere between $85 to $90 today. Okay, lots of volatility. In 2020, as an example, some of these names fell 50% during COVID because of the uncertainty. Well, for those of you that own Foresight in the last 3 years, this is the return you've received. It's done just under 8% annualized. It's been very consistent, okay? The reason why it looks like it goes up as a step, a little up, and then flat, up and flat, is because it gets valued every month, at the end of every month. So the benefit is smooths it out. You haven't seen the same volatility. And since inception, which was almost 5 years ago, it has never posted a negative quarter, not once, okay? And in all those months, it's only posted 1 negative month, and that was in March of 2020. It was down 0.15%. Okay. Every other month was positive, and every other quarter was positive. And for a lot of you on this call, a lot of our families, you own 10 to 15% of this pool, and we've owned these, in place of private or a public fixed income. Okay. Now let's look why private credit. Okay, why private credit? So for most Canadians, they own publicly traded debt or public credit, which is fixed income. It'd be bonds and so on and so forth. Okay, so private credit is a different asset class. So again, like real estate, enhanced diversification, lower volatility, strong income and return potential. Okay, again, lower correlation as well. So when we look at the traditional public fixed income over the last 3 years, it's actually fared a little bit better, okay? And it's because we're using 3 years from today. If we were to go back 2 months and look at 3 years, the return for fixed income would be flat because we were coming out of a period of time where inflation was high, interest rates were going up, and bonds were going down. Okay. So over the last 3 years, the total return, this is in Canada, this is in the US, has been anywhere between 5 to 9%. Okay. So annualized is anywhere between about 1.5 to 3%. Okay. Now, when we look at the private credit on Rockridge over the last 3 years, this is what it's done on the private side. It's done just under 7% annualized. Okay. So super strong, really pleased with it. And again, these managers, if we can get our CIO on our next call, they'll likely talk a little bit about how private debt plays into the portfolio allocation for those Canadians that can access it. Okay. And for a lot of folks on this call, we might own 10 to 15%, maybe a little bit more of this private credit pool because it's been very consistent and predictable. Okay. So these are the types of things that we've been doing to prepare to minimize downside risk and to try and smooth out this volatility, which has actually worked out quite well. Okay. All right. I'm going to leave you with kind of a last piece. This is my last slide, and then I'm going to actually just scroll through. I do see we have some questions. If you do have some questions, please type some in. I got a couple of them. So again, Warren Buffett, and when you look at investors in our lifetime, he's probably one of the most famous and successful. And another one is Sir John Templeton. He said the four worst words in the investment language is, "It's different this time." Okay. So I just want to reiterate that, when we get markets that are doing what they're doing, it might be a different catalyst. And what I mean by that, we've had inflation a couple of years ago. We've had trade or tariffs this time. In 2008, it was a financial crisis. Back in 2011, it was planes flying into the towers. Okay. 2001, 2000 was the tech wreck. Nobody could have predicted all those things. Okay. But the reaction of the markets, they're all very similar. If you go back in time, they all react very similar to negative news. Okay. So the same is true as we exit out of some of these uncertain times. Was that when things start to settle down, we are going to see growth again on the upside. And the question is, are we going to be taking advantage of it? Or, for some folks, are we going to be sitting on the sideline? So again, Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. So again, for those folks that are reaching out saying, "Hey, how can I take advantage of this?" If you guys have questions like that, please reach out to us. We're diarizing the folks that, maybe want to start to deploy some money into the markets. We're getting a list going so that when we have some cash or some opportunities, we can actually reach out to people and say, "Hey, this is what we're doing with our money. We think we should be adding at this level." Some of these companies are just too good to pass up. Okay. All right. Well, with this, I'm going to actually just go through the questions. I have a few here. Right off the bat, somebody had asked, actually, which was interesting. It says, "Is it worth to cash in some securities to buy U.S. stocks?" Which is a little different than what I said halfway through the session, where I said some people are asking, should we just get out of U.S. stocks altogether? So the answer is, I believe yes. Some of these companies are down 15, 20, 30% in the US because of the impact on the tariffs. And it doesn't mean their business is 20 to 30% less valuable. What's happening is it's their future business that's getting priced in. So again, when we look at earnings, if all of a sudden tariffs are going to represent 30%, if they don't pass that down to the consumer, then they're literally going to take a 30% haircut on their profits. Hence the reason why their stock goes down roughly that amount. But again, what I showed you from yesterday, when we get positive news, we could get a fairly quick recovery or some good upside here in the short term. And the US companies, some of these tech companies, have been beat up the most here in this short period of time. The other thing you can look to do, and again, I didn't have a slide for this, but a lot of folks are investing in GICs right now. They didn't know what to do with their money, a year or 2 years ago, and interest rates were at 4 or 5%. So what they did is they said, "I'm going to park it, with zero risk, and I'm going to get 4 to 5%. Well, after the 1 year, what's happening is they're recognizing that there's a lot of tax to be paid on that because interest income is taxed at the highest rate. Okay. In addition, their GICs are coming up for maturity, and now they're only able to get 2.5 to 3%, give or take. So one of the things that's happening right now is we're getting, good quality Canadian dividend companies, I mentioned it earlier, that are paying between 4 to 6% in dividend income, which is tax preferred. So for folks out there that maybe need cash flow and they have a reasonable time frame, again, it all depends on your risk tolerance and time frame, but perhaps now is a time that you could be looking at some of these cash flow type investments to add to the portfolio. So I think there's opportunities in more than just U.S. companies. Okay, bear with me, guys. I'm just going through here. All right, got a couple more here. Does gold bullion figure into today's current investment strategies? So that's a great question. What's happened in the last week? So gold has just come off a high. Gold has actually come down about 6 to 7%, surprisingly, since the tariffs were announced. I actually thought it would be the opposite. I thought when tariffs were announced, I thought we'd see some strengthening of it. But what's happening is there's a pullback across the board. So again, gold is just another asset class. We can add to it. Gold doesn't pay a dividend. Most of it is capital appreciation on the upside. Challenge with getting into gold today, you're getting into it near a high. That's one of the things we have to be mindful of. And the other thing is if all of a sudden things pick up, people are using gold to hedge some of the market risk. Well, when that risk scales back, then we could see gold actually come off a little bit of its high because people are going to naturally be rotating into some of these other companies that have been already beat up. Okay. Yeah, so here's another, this is a great question. How do you assess investment opportunities with the administration's extremely erratic behavior? Okay. And then they actually bring up technical analysis alone seems insufficient. So what that individual means is when you look at the valuation of a company or a security or what have you, you can look at it two ways. Technical analysis, which is all based on the trend of the stock. Is it above its 200-day moving average or its 50-day? Is it below? And you basically buy and sell it based on the trend. And then there's fundamental. There's fundamental analysis, which looks on the health of a company, right? What's their profits? What's their outlooks? Do they have anything in play that we feel is going to improve their financial situation in the near future? So as an example, sometimes we see companies that will acquire a company and perhaps it might be, the growth might be flat for an extended period of time until that company, that integration comes on board and actually increases their profit. So what we generally look at, we don't just look at technical analysis or fundamental, but generally we look at both of them. And so what I would focus on, with me, if I'm deploying money, I would actually look at, is it a good quality company? What is it? What are the outlook? Is the decline in that company justified? Is it a fundamental issue with the company? Is it going to be impacted in the long run? And if so, will their value go down because their profits aren't going to be as fruitful? Or is it more of a situation where that company has contracted based on a knee-jerk reaction? And I think what we're seeing today, it's more the latter. Okay. Now, if this situation prolongs, if it continues to go on, my concern is that it will lead to a fundamental slowdown. And what's going to happen, again, if all of a sudden GDP slows, if all of a sudden consumers stop spending, now we're getting into more of a recession type situation where the tariffs are prolonging a slowdown in the economy. And now we have to get, hopefully the banks or the central banks to start to stimulate the economy with easing the monetary policy, whether through rate cuts, whether adding money or doing different fixed income kind of buybacks and so on. I don't think we're quite at that point. Hopefully, we'll actually get some positive news out of the administration, which will right the ship here in the near term. And then again, if the outlook is favorable, then again, I think we start clawing back some of the declines we see in the market. Okay. All right, folks. I don't have any other questions. That was my last question. I kept you for just short of an hour. If any of you do have questions, our team is here. We're all on board. Send me an email. Send the team an email. We're happy to touch base. Like I said, you're in great hands. We've been through this before. This strategy that we have, it's proven. A lot of the folks that have been with me for 15, 20, 25 years, a lot of them are echoing the same comment. They're saying, hey, we've been through it with you before. We recognize that the world doesn't end, and there's definitely another side to this type of volatility. So they're quite comfortable. Okay. But for those of you that need a little bit of hand holding or some reassurance, that's what I find in these periods. Again, feel free to reach out. Our door is always open. Okay. Thank you for joining us. Again, I will send out something probably in the next 2 weeks for the next one. For the foreseeable future, we will do these sessions, I think, on a monthly basis. We'll play it by ear month to month, but the next one will be likely in the first week of May. And like I said, I'm going to do my best to get our chief investment officer as a guest speaker. I think she'd be fantastic. And then we'll look at perhaps adding some other guest speakers thereafter. And I'm always open for feedback of some of the ones that you'd like to see as well. Okay. So again, hang on, guys. Like I said, we're going to get through this. We're pointed in the right direction. Enjoy the rest of the week and the day. Stay dry, and we'll catch everybody soon. Take care.